Accounting is a process of analyzing, recording, summarizing, reporting, and interpreting the financial information of a business. It usually provides information to managers, owners, employees, etc. Business organizations that involve accounting would be sole proprietorship, partnership, and company. The accounting equation is assets equals to liabilities plus shareholders' equity, in which assets represent properties of value owned by a business, and liabilities representing debts owned by a business to outside parties, while shareholders' equity representing the shareholders' claim on net assets of the business. In accounting, there are three important concepts. They are the accounting entity concept, the monetary concept, and the historical cost concept. The accounting entity concept states that owner and the business are considered as separate entity where owner's personal transactions are kept separate and only business transactions are recorded. The monetary concept states that all transactions, on the other hand, should be recorded if it can be measured in monetary terms, while non-financial transactions should not be recorded. For example, customer loyalty, quality of workforce, etc. Lastly, the historical cost concept states that the transactions for the actual amount paid should be recorded, and the amount paid will not be adjusted due to inflation or market changes. It states that the amount recorded should be from source documents. Usually, a transaction involves at least two entities, and the accounting equation should be balanced after each transaction. Inventory in the accounting equation would refer to goods that a trading business buys for resale, while on credit would refer to buy and pay later, in which a liability is created when we buy on credit. Revenue and expenses in accounting are also interlinked, as revenue refers to the amount earned by selling goods to customers or by providing services, hence increasing shareholders' equity, while expenses refer to the costs incurred in running a business to create revenue, hence decreasing shareholders' equity.
The process of accounting can be summarized into the accounting cycle, an important concept of accounting that consists of a total of 7 steps. The first 3 steps are done daily, while steps 4 and 7 are done at the end of the accounting period when the company wishes to find out if it has made a profit or loss. For any business with accounting needs, the accounting cycle provides a model for efficient accounting procedures and ongoing processes, and it is used internationally by all kinds of accountants in order to determine their next course of action. The accounting period is a concept referring to how the lifespan of a business is broken into regular intervals. For example, closing accounts and preparing the financial statements at the end of each month to find out the company's profit or loss. The accounting period can also be a time period of 6 months or a year. In the accounting cycle, there is also another important concept called the going concern concept, whereby the company assumes that the business will continue to operate for a long time, thus considering the assets of the company as being valued at the historical cost and not at disposable value. The company, after recording business transactions in the general journal using the historical cost concept explained by Jonasta, will not adjust the values of the assets in the company according to the current market value, even in the future because of the going concern concept, thus making these two concepts linked to one another. The going concern concept is incredibly important to accounting services in Singapore, all of which follow the Singapore Financial Reporting Standards, who embraces this concept. Without this principle, businesses would not have the ability to make prepayments or accrue expenses. The first step of the accounting cycle states that we must first analyze our business transactions. There are 5 steps to doing this. The first is to identify the accounts affected, for example, cash or office equipment, before sorting them under the different categories such as assets or liabilities. Afterwards, depending on whether the accounts have decreased or increased, we apply the rules of debit and credit, and last but not least, we simply record the correct amount in the general journal. These steps cannot be switched around and must be followed in this exact order. Chuan will explain this first step of the accounting cycle as well as steps 2 and 3 in detail. These steps are crucial because it will directly affect the following steps of the accounting cycle, in turn affecting the accuracy of the company's assets should they be not done properly. Next will be step 4 of the accounting cycle, where companies will have to prepare a pre-closing trial balance. This is the list of the ending balances of all the accounts in the general ledger, where the total debit should be equal to the total credits. The balances and accounts can all be taken from the general ledger. This is an example of the pre-closing trial balance, prepared by different companies all around the world. since there is a pre-closing trial balance in the accounting cycle, there will also be a post-closing trial balance, which is step 7 of the accounting cycle. The difference between them is that where the pre-closing trial balance records down all the accounts in the general ledger, the post-closing trial balance has the accounts retained earnings, which is not found in the general ledger, and the reason why will be explained later on by Mirabelle. Steps 5 to 7 will also be further explained by her.
The reason why people use double entry system is because recording business transaction in traditional accounting equation is too tedious and is most likely not sustainable. And so double entry system was invented as it is easier to record transactions. So in a double entry system, it always shows the increase and decrease in each item of the accounting equation by accounts. All the accounts can be found in general ledger. A listing of all the accounts is called chart of accounts. And there are two types of account format for double entry system. One is the T account format. The other is a columnar account format. But most of the time you use the columnar account format. So what are the rules for double entry system? In double entry system, when assets increase, it will be recorded on the debit side, and when assets decrease, it will be recorded on the credit side. However, for liabilities and shareholders' equities are opposite. When liabilities and shareholders' equity increase, it will be recorded on the credit side instead of the debit side, and when they decrease, it will be recorded on the debit side. And next is the generalized business transaction. We'll record all the analysis in General Journal. General Journal is the book of original entry. It records all the informations in date order, which is also known as the chronological order. Debit entry is recorded first, then the credit entry is placed below the debit entry. Lastly, a simple explanation of the entry will also be included inside too. In General Journal, total amount of debits is always equals to the total amount of credits, and each transaction will at least affect 2 accounts. And this is an example of a General Journal. Next is General Ledger. General Ledger is different from General Journal by having an extra column for running balance here. Of credits or debit, the running balance for debit or credits. Okay. In addition, General Journal is recording by account and in a chronological order.
The statement of profit or loss allows us to see the company's revenue and expenses. We can understand a statement of profit or loss through the usage of formulas. For example, sales revenue minus sales returns and cost of sales allows accountants to find the gross profit. In turn, they will minus off the total operating expenses from the gross profit to find the net profit for the company in that specific accounting period. Over here, yeah. Another formula to take note of is the retained earnings at the end of the accounting period. Accountants will need to use the retained earnings from the previous month, if have, and add it to the amount of net profit to find the retained earnings at the end of the month. So it's this part over here, yeah. Moreover, the statement of profit or loss is also used hand in hand with the statement of financial position. For example, in order for companies to come up with the statement of financial position, you have to prepare the statement of profit or loss first. Preparing closing entries involves closing temporary accounts, such as your sales revenue, your sales returns, your total operating expenses, your profit or loss, and your retained earnings in the general ledger. To do this, you will need to either debit or credit the amount of profit or loss or retained earnings, depending on the account. So there is no outstanding balance in any of the temporary accounts. Once you do all of this, then you have to prepare the post-closing trial balance. Essentially, accountants have to total up all the permanent accounts such as cash, inventory, bank loan, and ordinary share capital. But they also must total up the amount of retained earnings they have at the end of the accounting period, which relates back to the statement of profit or loss.